Question 1. When evaluating the potential impact of terrorism on marine insurance portfolios, which approach best aligns with the principles of prudent underwriting and regulatory compliance within the UK framework? Option A. Relying exclusively on historical claims data related to terrorism incidents to inform premium adjustments and coverage decisions. Option B. Implementing a blanket exclusion of all terrorism-related risks from marine insurance policies without a detailed threat analysis. Option C. Conducting a comprehensive risk assessment that integrates current threat intelligence, vessel-specific vulnerabilities, and the effectiveness of security measures, in line with ISP's code requirements and UK maritime security legislation. Option D. Applying a uniform percentage increase to all marine insurance premiums, based on a general perception of heightened global terrorism risk. Correct answer is C. Conducting a comprehensive risk assessment that integrates current threat intelligence, vessel-specific vulnerabilities, and the effectiveness of security measures, in line with ISP's code requirements and UK maritime security legislation. Explanation. This scenario is professionally challenging because the AMIM candidate must navigate the complex interplay between evolving terrorism threats, international maritime security conventions, and the practicalities of marine insurance underwriting. The core difficulty lies in accurately assessing and pricing the risk associated with terrorism in a dynamic geopolitical landscape, while adhering to the specific regulatory framework governing marine insurance in the relevant jurisdiction, assumed to be UK/CISI for this exam. A failure to do so can lead to underpricing, leaving the insurer exposed to catastrophic losses, or overpricing, making coverage unaffordable and uncompetitive. The correct approach involves a comprehensive risk assessment that integrates intelligence on current terrorist threats, analysis of vessel vulnerabilities, and consideration of existing security measures, all within the scope of the International Maritime Organization's IMO ISP's code and relevant UK maritime security legislation. This approach acknowledges that terrorism risk is not static and requires continuous monitoring and adaptation. It aligns with the principles of prudent underwriting and the duty of care owed to policyholders and the insurer's stakeholders. Specifically, it reflects the need to understand the underlying risks before determining appropriate coverage and pricing, as mandated by principles of good insurance practice and regulatory oversight bodies like the Financial Conduct Authority, FCA, in the UK, which expects firms to manage risks effectively. An incorrect approach that focuses solely on historical claims data for terrorism-related incidents would be a significant regulatory and ethical failure. This is because historical data may not adequately reflect current or emerging threats, leading to an underestimation of risk. Relying solely on historical data ignores the proactive risk management expected under regulatory frameworks that emphasize forward-looking risk assessment. Another incorrect approach, which is to exclude terrorism coverage entirely without a thorough risk assessment, is also professionally unsound. While it mitigates direct financial exposure to terrorism claims, it fails to meet the market's needs and potentially breaches the duty to provide appropriate insurance products where risks can be reasonably assessed and managed. Furthermore, it may contravene principles of fair competition and market access if other insurers are offering such coverage. A third incorrect approach, which is to simply apply a blanket percentage increase to all premiums based on a general perception of increased global terrorism risk, is also flawed. This lacks the specificity required for accurate risk assessment and pricing. It fails to differentiate between vessels operating in high-risk versus low-risk areas, or those with varying levels of security preparedness. This arbitrary approach can lead to unfair pricing for some policyholders and does not demonstrate the diligent underwriting expected by regulators. The professional decision-making process for similar situations should involve a structured risk assessment framework. This begins with identifying potential threats, analyzing their likelihood and impact, evaluating existing controls, and then determining the appropriate response, which may include risk mitigation, transfer insurance, or acceptance. For terrorism risk in marine insurance, this means actively seeking and analyzing intelligence, consulting with security experts, understanding the specific operational context of the insured vessel, and then applying underwriting principles to determine terms, conditions, and pricing. This process should be documented and regularly reviewed to ensure its continued relevance and effectiveness. Question 2. The performance metrics show a consistent increase in claims related to voyage delays and port congestion impacting vessel schedules. As an associate in marine insurance management, what is the most appropriate course of action when reviewing the potential coverage under a disbursements insurance policy for a client experiencing these issues? Option A. Immediately advise the client that voyage delays and port congestion are typically excluded from standard disbursements insurance and recommend they seek alternative coverage. Option B. Conduct a detailed review of the specific disbursements insurance policy wording to determine the scope of coverage for financial losses arising from voyage delays and port congestion. Engage with the insured to understand their specific exposures, and consult with the underwriter for clarification or endorsement if necessary. Option C. Interpret the policy broadly to cover all financial losses incurred by the client due to voyage delays and port congestion, assuming the insurer will accept the increased exposure. Option D. Inform the client that while the policy may not explicitly cover delays, they should proceed with incurring costs related to mitigating these delays, as the insurer will likely reimburse them. The correct answer is A. Immediately advise the client that voyage delays and port congestion are typically excluded from standard disbursements insurance and recommend they seek alternative coverage. Explanation. The performance metrics show a consistent increase in claims related to voyage delays and port congestion impacting vessel schedules. This scenario is professionally challenging because it directly affects the profitability and operational efficiency of shipping companies, and consequently, the marine insurance market's exposure. Disbursements insurance, while covering a broad range of financial interests beyond hull and machinery, is particularly sensitive to these types of operational disruptions. A marine insurance manager must navigate the complexities of policy wording, underwriter expectations, and the insured's legitimate need for coverage against such risks, all within the strict regulatory framework governing insurance practices. The correct approach involves a thorough review of the existing disbursements insurance policy, wording to ascertain the precise scope of coverage for losses arising from voyage delays and port congestion. This includes examining definitions of loss, delay, and any specific exclusions or conditions related to operational disruptions. The manager must then engage with the insured to understand the nature and extent of their financial exposure due to these performance metric trends. Subsequently, a dialogue with the underwriter is crucial to discuss the observed trends, the policy's applicability, and potential avenues for clarification or endorsement if the current wording is ambiguous or insufficient. This proactive and collaborative approach ensures that both the insured's expectations and the underwriter's risk appetite are managed effectively, adhering to principles of good faith and transparency fundamental to insurance contracts. This aligns with the regulatory expectation for insurance professionals to act with due skill, care, and diligence, and to ensure that policies accurately reflect the risks being insured. An incorrect approach would be to assume that all financial losses stemming from voyage delays and port congestion are automatically covered under a standard disbursements policy without detailed scrutiny of the policy terms. This overlooks the principle that insurance coverage is based on specific contractual agreements and the principle of indemnity, meaning only insurable interests that are demonstrably lost or diminished due to a covered peril are recoverable. This failure to meticulously examine policy wording and engage with the underwriter could lead to disputes and a misrepresentation of coverage. Another incorrect approach would be to unilaterally offer coverage extensions or interpret the policy in a manner favorable to the insured without consulting the underwriter. This breaches the duty of good faith owed to the underwriter and could expose the insurer to risks they have not agreed to underwrite, potentially violating regulatory requirements regarding underwriting authority and proper risk assessment. A further incorrect approach would be to dismiss the insured's concerns outright, citing a narrow interpretation of the policy without first investigating the specific circumstances and the potential for coverage under the existing terms or through clarification. This demonstrates a lack of due diligence and a failure to act in the best interests of the client, potentially leading to reputational damage and regulatory scrutiny for failing to provide adequate service. Professionals should adopt a systematic decision-making process. First, understand the insured situation and their perceived loss. Second, meticulously review the relevant policy wordings and applicable regulations. Third, consult with the underwriter to clarify coverage and discuss potential adjustments. And finally, Communicate clearly and transparently with the insured regarding the coverage position. Question 3. Market research demonstrates that while the overall volume of trade in commodities, manufactured goods, and perishables is increasing, the specific risk profiles of these cargo types vary significantly. An AMIM candidate is tasked with advising on the appropriate risk assessment approach for ensuring a new shipping line's diverse cargo portfolio. Which of the following approaches best aligns with the principles of sound marine insurance underwriting and regulatory compliance for the Associated Marine Insurance Management AMIM exam, focusing on the UK regulatory framework and SISI guidelines? Option A. Conduct a detailed risk assessment for each cargo category, considering its inherent vulnerabilities, susceptibility to specific marine perils, e.g., spoilage for perishables, damage during handling for manufactured goods, contamination for commodities, and the effectiveness of mitigation measures. Option B. Prioritize assessing the overall market value and volume of each cargo category to determine premium levels, assuming that higher value and volume inherently equate to higher risk. Option C. Focus on the speed of quotation by using standardized risk assessment templates that apply a uniform risk factor across all cargo types, regardless of their specific characteristics. Option D. Rely primarily on the shipping line's historical claims data for each cargo category, without independently verifying the underlying risk factors or the adequacy of their current risk management practices. The correct answer is B. Prioritize assessing the overall market value and volume of each cargo category to determine premium levels, assuming that higher value and volume inherently equate to higher risk. Explanation: this scenario is professionally challenging because accurately assessing the risk associated with diverse cargo types requires a nuanced understanding beyond simple classification. The AMIM framework emphasizes a thorough risk assessment process, considering the inherent characteristics of commodities, manufactured goods, and perishables, and how these interact with potential marine perils. The challenge lies in moving from a general understanding of cargo types to a specific, actionable risk profile that informs underwriting decisions and premium calculations, all within the bounds of UK regulatory requirements and SISI guidelines. The correct approach involves a detailed risk assessment that categorizes cargo based on its inherent vulnerabilities and potential for loss, considering factors like susceptibility to damage, spoilage, theft, and the impact of transit conditions. This aligns with the AMIM focus on practical application of marine insurance principles. Specifically, it requires underwriters to evaluate the specific risks associated with each cargo category. For example, the temperature control needs of perishables, the potential for damage to manufactured goods during handling, or the volatility of certain commodities. This detailed evaluation ensures that premiums accurately reflect the risk and that appropriate policy terms and conditions are applied, adhering to the principles of utmost good faith and prudent underwriting expected under UK regulations. An incorrect approach that focuses solely on the volume or value of cargo without considering its specific risk profile fails to meet the professional standards of marine insurance. This overlooks the fundamental principle that different cargo types present vastly different risk exposures. For instance, treating a shipment of high-value electronics, manufactured goods, the same as a bulk shipment of grain commodity, without differentiating their specific handling and transit risks would be a significant oversight. This approach could lead to underpricing of risk for more vulnerable cargo or overpricing for less vulnerable cargo, potentially breaching regulatory expectations for fair and accurate risk assessment. Another incorrect approach that prioritizes speed of quotation over thorough risk assessment is also professionally unacceptable. While efficiency is valued, it must not come at the expense of due diligence. Marine insurance is a complex field where inadequate risk assessment can lead to significant financial losses for both the insurer and the insured, and potentially regulatory scrutiny. Failing to investigate the specific nature of perishables, such as their required transit environment or shelf life, before quoting would be a direct contravention of the prudent underwriting expected under UK law and SISI guidelines. The professional decision-making process for similar situations should involve a structured risk assessment framework. This begins with identifying the cargo type and its general classification. Subsequently, it requires a deep dive into the specific characteristics of that cargo relevant to marine transit, such as its physical properties, susceptibility to damage, value, and any special handling or storage requirements. This information should then be used to evaluate the potential perils and their likely impact, leading to an informed decision on coverage, terms, and pricing. Adherence to regulatory requirements and ethical considerations, such as utmost good faith, should guide every step of this process. Question 4. Regulatory review indicates that a marine insurance manager is assessing a proposal for hull and machinery insurance on a vessel. The owner has provided documentation suggesting the vessel's market value is significantly higher than its insured value, and has also indicated a recent change in beneficial ownership that was not fully detailed in the initial proposal. The manager is aware that the vessel is frequently chartered to carry high-value cargo, considering the fundamental principles of insurance as applied within the AMIM regulatory framework. Which of the following approaches best ensures compliance and professional integrity? Option A. Accept the owner's stated insured value without further inquiry, as the existence of a charter for high-value cargo inherently establishes a sufficient insurable interest for the purpose of the insurance contract. Option B. Advise the owner that the insured value appears to be significantly below the market value, which may indicate a potential issue with the principle of indemnity, and request further clarification and documentation regarding the vessel's true value and the specifics of the beneficial ownership change before proceeding. Option C. Recommend insuring the vessel at a value significantly above its market value to account for potential future charter earnings and the high value of cargo it might carry, thereby maximizing the potential payout in case of a total loss. Option D. Proceed with the insurance based on the provided documentation, assuming the owner's valuation is accurate and the change in beneficial ownership is a minor administrative detail, as the primary concern is the vessel's operational capacity for high-value cargo. Correct answer is D. Proceed with the insurance based on the provided documentation, assuming the owner's valuation is accurate and the change in beneficial ownership is a minor administrative detail, as the primary concern is the vessel's operational capacity for high-value cargo. Explanation. This scenario presents a professional challenge because it requires the marine insurance manager to navigate the fundamental principles of insurance, specifically indemnity, insurable interest, and utmost good faith, within the strict confines of the Associate in Marine Insurance Management, AMIM, regulatory framework. The challenge lies in accurately applying these principles to a real-world situation where conflicting information or potential misrepresentations might arise, necessitating a thorough understanding of legal and ethical obligations. Careful judgment is required to ensure that any proposed insurance arrangement adheres to these core principles, thereby protecting both the insured and the insurer, and maintaining the integrity of the insurance market. The correct approach involves a meticulous assessment of whether the proposed insurance contract satisfies the principle of indemnity, ensuring the insured is restored to their pre-loss financial position without profit. It also requires verifying the existence of a legitimate insurable interest at the time of the loss, meaning the insured would suffer a financial detriment if the insured event occurred. Crucially, it demands upholding the principle of utmost good faith, uberrimi fidei, by ensuring all material facts have been disclosed by both parties, and that no misrepresentation or non-disclosure has occurred. This approach is correct because it directly aligns with the foundational legal and ethical requirements of insurance contracts as understood within the AMIM jurisdiction. Adherence to these principles is not merely good practice but a regulatory imperative, designed to prevent fraudulent claims and ensure fair compensation. An incorrect approach that focuses solely on the potential for profit for the insured by overinsuring the vessel fails to uphold the principle of indemnity. This would allow the insured to gain financially from a loss, which is contrary to the fundamental purpose of insurance. Such an approach would also likely breach the duty of utmost good faith if the insurer was not made aware of the overinsurance, or if the insured actively sought to exploit it. Another incorrect approach that overlooks the need for a clear insurable interest at the time of the loss is also professionally unacceptable. If the insured no longer has a financial stake in the vessel or its cargo at the point of damage or loss, they cannot claim under the policy, as insurance is designed to protect against financial detriment, not to provide a windfall. This failure to verify insurable interest undermines the very basis of the insurance contract. A third incorrect approach that prioritizes expediency over thorough disclosure, by accepting information at face value without independent verification, or seeking clarification on ambiguous details, directly violates the principle of utmost good faith. This principle places a high burden on both parties to be transparent and honest. Failing to do so, even unintentionally, can invalidate the policy and lead to regulatory sanctions. The professional decision-making process for similar situations should involve a systematic review of the proposed insurance against each fundamental principle. This includes 1. Confirming the insured's financial stake and its timing insurable interest. 2. Evaluating the proposed sum insured against the actual value to ensure it aligns with the principle of indemnity. 3. Actively seeking and verifying all material facts and ensuring complete and honest disclosure from all parties involved, thereby upholding utmost good faith. If any doubt arises, further investigation, clarification, or seeking expert advice is paramount. Question 5. Strategic planning requires a marine insurance manager to assess the implications of a client's vessel changing its primary operational area from the North Atlantic to the Persian Gulf, a region known for increased geopolitical instability and potential war risks. The vessel is currently insured under an Institute Time Clauses Hull's ICH policy. Which of the following actions best reflects the professional and regulatory requirements for managing this change in risk? Option A. Immediately inform the underwriters of the proposed change in trading limits and the increased exposure to war risks, requesting confirmation of cover and any necessary endorsements or premium adjustments. Option B. Advise the client that the ICH policy automatically covers all operational areas and war risks unless specifically excluded, and no further action is required. Option C. Proceed with the vessel's relocation to the Persian Gulf and await a potential claim to see how the existing policy responds to the new circumstances. Option D. Assume the existing ICH policy provides adequate cover for the new operational area and war risks, as the vessel's hull and machinery remain the same. Correct answer is A. Immediately inform the underwriters of the proposed change in trading limits and the increased exposure to war risks, requesting confirmation of cover and any necessary endorsements or premium adjustments. Explanation. This scenario is professionally challenging because it requires the marine insurance manager to interpret and apply the Institute Time Clauses Hull's ICH in a situation where the vessel's operational scope has changed significantly, potentially impacting the risk profile and the validity of the insurance cover. The manager must balance the insured's desire for continued coverage with the insurer's need to accurately assess and price risk, all within the framework of the ICH. Careful judgment is required to avoid either overinsuring a reduced risk or underinsuring an increased risk, leading to potential disputes or financial loss. The correct approach involves a thorough review of the ICH, specifically Clause 7, Trading Limits, and Clause 8, Inclusion of War Risks, to determine how the vessel's new operational area and the potential for increased war risk exposure affect the existing policy. This approach necessitates proactive communication with the underwriters to declare the change in trading limits and to seek confirmation or amendment of the war risks cover. This is the correct professional practice because it adheres to the principles of utmost good faith, uberrimi fidei, inherent in insurance contracts. By informing the underwriters of material changes, the manager ensures that the policy accurately reflects the current risk, allowing for appropriate premium adjustments and preventing potential claims disputes arising from misrepresentation or non-disclosure. This aligns with the general duty of disclosure and the specific provisions of the ICH regarding trading warranties and war risks. An incorrect approach would be to assume that the existing ICH cover automatically extends to the new trading limits and war risk environment without consultation. This fails to acknowledge the contractual limitations imposed by Clause 7, which typically specifies geographical trading limits. Operating outside these limits without endorsement can render the policy void or limit the insurer's liability. Furthermore, it ignores the separate and often excluded nature of war risks, which are addressed in Clause 8 and usually require specific agreement and additional premium. This approach breaches the duty of disclosure and the contractual obligations under the policy. Another incorrect approach would be to unilaterally decide that the increased risk is negligible and proceed without informing the underwriters. This demonstrates a lack of understanding of the risk assessment process and the importance of underwriter approval for deviations from agreed terms. It also bypasses the established procedure for managing changes in risk, potentially exposing the insured to uninsured losses if a claim arises in the new operational area or due to war risks. A third incorrect approach would be to focus solely on the insured's immediate operational needs, without considering the contractual implications for the insurance policy. While customer service is important, it must be balanced with adherence to the terms and conditions of the insurance contract. Ignoring the ICH provisions in favor of expediency would be a dereliction of the marine insurance manager's professional duty to both the insured and the insurer. The professional decision-making process for similar situations should involve 1. Identifying the change in operational circumstances. 2. Consulting the relevant clauses of the Institute Time Clauses Hull's ICH, particularly those pertaining to trading limits and war risks. 3. Assessing the potential impact of the change on the risk profile. 4. Proactively communicating with the underwriters to declare the change and seek necessary endorsements or amendments to the policy. 5. Documenting all communications and agreements. This systematic approach ensures compliance with the policy terms, upholds the principle of utmost good faith, and protects the interests of all parties involved. Question 6. The evaluation methodology shows that when assessing a claim for damage to a consignment of perishable goods, an associate in marine insurance management, AMIM, must consider the impact of packing and stowage. Which of the following approaches best reflects the professional and regulatory obligations when investigating such a claim? Option A. Investigate the specific type of packaging used, its condition, and its suitability for the voyage, alongside the method of stowage within the vessel, to determine if these factors contributed to the loss and if the assured exercised due diligence. Option B. Accept the assured statement that the goods were properly packed and stowed without further inquiry, as the primary responsibility for cargo care lies with the carrier. Option C. Prioritize the speed of claim settlement by approving the claim based on the initial report from the assured, deferring any detailed investigation into packing and stowage to a later stage if necessary. Option D. Focus on the extent of the visible damage to the perishable goods upon discharge and process the claim based on the insured value, assuming the carrier is responsible for any transit damage. The correct answer is D. Focus on the extent of the visible damage to the perishable goods upon discharge and process the claim based on the insured value, assuming the carrier is responsible for any transit damage. Explanation. The evaluation methodology shows that assessing the impact of packing and stowage on marine cargo insurance claims requires a nuanced understanding of both practical shipping considerations and the specific regulatory framework governing marine insurance in the relevant jurisdiction. This scenario is professionally challenging because it demands the insurance professional to go beyond simply identifying a loss. They must critically evaluate the root causes, which often lie in the pre-shipment and loading phases, and determine the extent to which the insurer's liability is affected by the assured's adherence to or deviation from established standards. The correct approach involves a thorough investigation into the specific packing materials used, their suitability for the intended voyage and cargo type, and the method of stowage within the vessel. This includes verifying that the packing met any mandatory or recommended standards e.g., those outlined by the International Maritime Organization, IMO, or specific cargo industry bodies, as referenced in relevant policy wordings or industry best practices that are implicitly or explicitly incorporated into the insurance contract. The professional must also assess whether the stowage plan was appropriate, considering factors like weight distribution, segregation of incompatible goods, and protection from environmental factors such as moisture and movement. The regulatory justification for this approach stems from the principles of utmost good faith and the doctrine of proximate cause. The insurer is only liable for losses proximately caused by a peril insured against. If inadequate packing or improper stowage directly leads to or exacerbates the loss, and this is found to be due to the assured's negligence or failure to exercise due diligence, as may be stipulated in the policy or implied by the duty of care, the insurer may be able to deny or reduce the claim. The investigation must therefore establish a clear causal link and assess the assured's compliance with their obligations. An incorrect approach would be to solely focus on the visible damage to the cargo upon arrival, without investigating the underlying causes of that damage. This fails to address the proximate cause of the loss and may lead to the insurer paying for damage that was preventable or caused by the assured's own actions or omissions. Ethically, this is problematic as it could result in an unfair payout where the assured has not met their responsibilities. Another incorrect approach would be to assume that any damage to the cargo automatically constitutes a valid claim under the policy, irrespective of how it was packed or stowed. This ignores the fundamental principles of marine insurance, which often include exclusions for inherent vice, insufficient packing, or damage arising from the assured's failure to take reasonable precautions. This approach is not only regulatorily unsound, but also professionally negligent, as it fails to uphold the insurer's right to investigate and potentially reject claims that fall outside the scope of coverage due to the assured's noncompliance. A third incorrect approach would be to rely on anecdotal evidence or general assumptions about how a particular type of cargo is typically packed or stowed, without seeking specific evidence related to the insured shipment. Marine insurance is a contract based on specific facts and circumstances. Generalizations can lead to incorrect assessments of liability and undermine the integrity of the claims process. A professional decision-making process for similar situations should involve a systematic approach. First, thoroughly review the insurance policy wording and any applicable endorsements or clauses related to packing and stowage. Second, gather all relevant documentation, including packing lists, stowage plans, bills of lading, and any pre-shipment surveys or reports. Third, conduct a detailed inspection of the damaged cargo and its packaging, noting any deficiencies. Fourth, interview the assured and any relevant third parties, e.g., stevedores, carriers, to understand the handling and stowage procedures. Finally, analyze all gathered information against the policy terms and relevant regulatory requirements to determine the proximate cause of the loss and the insurer's liability. Question 7. The control framework reveals that when a vessel sustains damage during a voyage, the hull insurance claim process requires careful consideration of several factors. If a claim is submitted for repairs to damage that may have been caused by a combination of perils, including wear and tear, and a specific insured peril, which approach best aligns with the principles of hull insurance and the governing regulatory framework for the Associated Marine Insurance Management (AMIM) exam. Option A. Deny the claim outright, citing wear and tear as a general exclusion without further investigation into the specific circumstances. Option B. Immediately approve the claim for the full repair cost based on the insured's submission, as the vessel was insured against perils of the sea. Option C. Settle the claim for a reduced amount based on a subjective assessment of the insured's perceived fault, without formal investigation or expert input. Option D. Conduct a thorough investigation to determine the proximate cause of the damage, obtaining expert surveyor reports to differentiate between damage caused by wear and tear and damage caused by an insured peril, and then assess coverage accordingly. The correct answer is B. Immediately approve the claim for the full repair cost based on the insured's submission, as the vessel was insured against perils of the sea. Explanation. The control framework reveals that managing hull insurance claims requires a nuanced understanding of both the policy terms and the applicable regulatory environment. This scenario is professionally challenging because it involves a potential conflict between the insured's desire for a swift settlement and the insurer's obligation to adhere to regulatory requirements and policy conditions, particularly concerning the assessment of damage and the determination of liability. Careful judgment is required to balance these competing interests while ensuring compliance and maintaining the integrity of the insurance process. The correct approach involves a thorough investigation of the casualty, a meticulous review of the hull insurance policy's clauses, and strict adherence to the Marine Insurance Act 1906, as this is the governing legislation for the AMIM exam jurisdiction. This includes obtaining expert surveyor reports to accurately assess the extent of damage, determining the proximate cause of loss, and verifying that the loss is covered under the policy terms. The insurer must then communicate clearly and transparently with the insured regarding the claim's progress and the basis for any settlement or denial, ensuring all actions are justifiable under the law and the policy. This approach upholds the principles of good faith and fair dealing, which are fundamental to insurance contracts and are reinforced by regulatory expectations. An incorrect approach that focuses solely on the insured's immediate financial needs without a proper investigation would fail to uphold the insurer's duty to assess the claim accurately and in accordance with policy terms and the Marine Insurance Act 1906. This could lead to underpayment or overpayment of claims, both of which are detrimental to the insurer's financial stability and reputation. Another incorrect approach that prioritizes expediency over regulatory compliance, such as settling a claim without obtaining necessary expert reports or verifying coverage, risks violating the Marine Insurance Act 1906 and potentially breaching the duty of utmost good faith. This could expose the insurer to regulatory sanctions and legal challenges. Furthermore, an approach that misinterprets or selectively applies policy clauses to avoid liability without a sound legal or factual basis would be ethically and legally unsound. This demonstrates a failure to act with integrity and could result in a breach of contract and reputational damage. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the policy and relevant legislation. This involves gathering all necessary factual information, seeking expert advice where required, and applying legal and contractual principles consistently. Transparency and clear communication with all parties involved are paramount throughout the claims handling process. This structured approach ensures that decisions are informed, defensible, and aligned with both regulatory obligations and ethical standards. Question 8. Research into the insurance arrangements for a new superyacht construction project has revealed that the shipyard, the insured party, is seeking clarification on whether the builder's risk policy will cover damage arising from a latent defect discovered during sea trials. The shipyard's project manager has stated that they expect all construction-related issues to be covered until handover. As an associate in Marine Insurance Management AMIM, what is the most appropriate course of action to advise the shipyard? Option A. Inform the shipyard that their expectation of full coverage until handover is standard for builders' risk policies and that latent defects are typically included unless specifically excluded. Option B. Recommend that the shipyard immediately contact the vessel's classification society to confirm their standards regarding latent defects in new builds, as this will dictate insurance coverage. Option C. Advise the shipyard to review the specific wording of their builder's risk policy, paying close attention to clauses defining insured perils, exclusions related to latent defects, and any conditions precedent to liability, and then consult the Marine Insurance Act 1906 for relevant legal principles governing policy interpretation. Option D. Assure the shipyard that, as long as the defect was not caused by their negligence, the builder's risk policy will cover the damage, as the vessel is still under construction. The correct answer is C. Advise the shipyard to review the specific wording of their builder's risk policy, paying close attention to clauses defining insured perils, exclusions related to latent defects, and any conditions precedent to liability, and then consult the Marine Insurance Act 1906 for relevant legal principles governing policy interpretation. Explanation. Scenario analysis. This scenario presents a common challenge in marine insurance management where a policyholder, a shipyard, seeks to understand the scope of coverage for a new build project under a builder's risk policy. The complexity arises from the potential for differing interpretations of what constitutes work in progress and the specific perils that are typically excluded or require endorsement. A professional AMIM must navigate these ambiguities by referencing the policy wording and relevant regulatory guidance to provide accurate advice, ensuring the client understands their coverage limitations and responsibilities. Failure to do so can lead to underinsurance, disputes, and reputational damage. Correct approach analysis. The correct approach involves a meticulous review of the specific builder's risk policy wording, paying close attention to the definitions of insured property, the perils covered, and any exclusions or conditions. This is then cross-referenced with the relevant provisions of the Marine Insurance Act 1906, as this is the foundational legislation for UK marine insurance, consistent with the AMIM syllabus. The Act, particularly sections relating to the policy as a contract of utmost good faith and the construction of policy terms, provides the legal framework for interpreting the policy. The AMIM role is to explain how these legal principles and policy clauses apply to the shipyard situation, advising on potential gaps and the need for endorsements to cover specific risks like faulty design or materials if not already included. This ensures the client is fully informed and can make appropriate decisions regarding their insurance program. Incorrect approaches analysis. Advising based solely on general industry practice without consulting the specific policy wording and the Marine Insurance Act 1906 is an incorrect approach. This fails to acknowledge that each policy is a bespoke contract and that general assumptions can be dangerously misleading. It also neglects the legal obligations imposed by the Act, such as the duty of disclosure and the principles of indemnity. Relying exclusively on the shipyard's verbal assurances about their perceived coverage without verifying against the policy documents and relevant legislation is another incorrect approach. This bypasses the contractual nature of insurance and the importance of written terms. It also ignores the AMIM professional responsibility to ensure clarity and accuracy based on documented evidence. Suggesting that the policy automatically covers all risks associated with a new build project without a thorough examination of the policy's exclusions and conditions is also incorrect. Builders' risk policies are subject to specific exclusions, such as wear and tear, inherent vice, and often require specific endorsements for certain types of damage or risks like faulty workmanship or design. A failure to identify and communicate these limitations is a significant professional failing. Professional reasoning. Professionals in marine insurance management must adopt a systematic approach. This begins with understanding the client's specific needs and the nature of the risk. Crucially, it involves a thorough examination of the insurance contract, the policy wording, and the governing legal framework. In this context, the Marine Insurance Act 1906. Any advice provided must be grounded in these documents. When ambiguities arise, the professional should seek clarification from the underwriter or refer to established legal interpretations. Transparency and clear communication with the client about coverage scope, limitations, and potential gaps are paramount. This process ensures compliance, upholds the principles of utmost good faith, and protects both the client and the professional from potential liabilities. Question 9. To address the challenge of a client requesting the omission of a known, but potentially minor, pre-existing condition from a marine insurance application to reduce the premium under Institute Voyage Clauses Hull's IVCH, which approach best upholds professional and regulatory obligations? Option A. Agree to the client's request and omit the pre-existing condition from the application to secure the business and maintain client satisfaction by offering a lower premium. Option B. Advise the client that all material facts, including the pre-existing condition, must be disclosed to the underwriter as per the duty of utmost good faith and the requirements of the IVCH, explaining the potential consequences of non-disclosure, and offer to discuss how the condition might be managed within the policy terms or if it impacts the risk. Option C. Inform the client that while disclosure is generally important, for minor issues, it is often acceptable to omit them to achieve a more competitive premium, and proceed with the application without further inquiry into the condition. Option D. Proceed with the insurance application as is, assuming the pre-existing condition is minor and unlikely to be discovered or to affect any future claims, thereby avoiding immediate client dissatisfaction. Correct answer is B. Advise the client that all material facts, including the pre-existing condition, must be disclosed to the underwriter as per the duty of utmost good faith and the requirements of the IVCH, explaining the potential consequences of non-disclosure, and offer to discuss how the condition might be managed within the policy terms or if it impacts the risk. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's desire to minimize immediate costs and the underwriter's duty to ensure accurate and complete disclosure of material facts, which is fundamental to the principle of utmost good faith in insurance. The underwriter must navigate this by upholding their professional and regulatory obligations, even when it might lead to a less favorable outcome for the client in the short term. The correct approach involves clearly explaining to the client the implications of the Institute Voyage Clauses Hull's IVCH and the importance of declaring all known circumstances that could influence the underwriter's assessment of risk. This aligns with the regulatory framework governing insurance professionals, which mandates honesty, integrity, and the duty to act in the best interests of the client while also adhering to the principles of insurance law. Specifically, duty of disclosure, a cornerstone of marine insurance, requires the insured to reveal all material facts known to them that would influence the judgment of a prudent underwriter in fixing the premium or deciding whether to accept the risk. Failure to do so can render the policy voidable. An incorrect approach would be to agree to omit the information to appease the client. This directly violates the duty of utmost good faith and the legal requirement for full disclosure. It exposes the underwriter to potential regulatory sanctions for misrepresentation or non-disclosure and could invalidate the insurance policy, leaving the client unprotected and potentially facing legal repercussions. Another incorrect approach is to proceed with the insurance without fully understanding the implications of the omitted information. This demonstrates a lack of due diligence and a failure to properly assess the risk, which is a core responsibility of an underwriter. It also fails to educate the client on their responsibilities, potentially leading to future disputes. A further incorrect approach is to pressure the client into providing information they are reluctant to share without explaining the legal and contractual ramifications. While disclosure is paramount, the manner in which it is pursued should be professional and informative, not coercive. The professional decision-making process for similar situations requires a commitment to ethical conduct and regulatory compliance. It involves 1. Identifying the core issue, the tension between client cost-saving and the duty of disclosure. 2. Recalling relevant legal and regulatory obligations, the principle of utmost good faith, and the duty of disclosure under marine insurance law. 3. Communicating clearly and professionally with the client, explaining the risks and requirements. 4. Documenting all advice given and decisions made. 5. Seeking guidance from senior colleagues or legal counsel if the situation is complex or the client remains uncooperative. The ultimate goal is to ensure a valid and fair insurance contract is in place, protecting both the insurer and the insured. Question 10. Analysis of a vessel insured under a standard hull and machinery policy with attached Institute war clauses. Hulls sustains damage while transiting a declared war zone. The assured submits a claim for the damage, asserting it is a direct consequence of hostilities. Which approach best aligns with the regulatory framework and professional practice for managing this claim? Option A. Focus solely on the hull policy's exclusions for damage caused by warlike operations, as this is the primary document governing the vessel's insurance. Option B. Immediately assess the damage against the Institute war clauses, hulls, to determine if the damage is a direct result of a war peril as defined within those clauses, and if so, proceed with the claim settlement process in accordance with policy terms and conditions. Option C. Assume the damage is covered under the hull policy's general perils as the vessel was operating in a war zone, and process the claim accordingly without detailed scrutiny of the war risks clauses. Option D. Advise the assured that any damage occurring in a war zone is automatically covered by the war risks insurance, regardless of the specific cause, and proceed with immediate payment. The correct answer is B. Immediately assess the damage against the Institute war clauses, hulls, to determine if the damage is a direct result of a war peril as defined within those clauses, and if so, proceed with the claim settlement process in accordance with policy terms and conditions. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of how war risks insurance interacts with hull insurance, specifically concerning the scope of coverage and the potential for disputes arising from the interpretation of policy wordings and the application of specific exclusions. The AMIM syllabus emphasizes the practical application of marine insurance principles, and this question tests the ability to identify the most appropriate and compliant approach to managing a claim under such complex circumstances. Careful judgment is required to ensure that the insured's interests are protected, while adhering strictly to the terms of the policy and relevant regulatory guidelines. The correct approach involves a thorough review of the specific war risks clauses attached to the hull policy and the underlying hull policy itself, to determine the precise scope of coverage for damage sustained during a declared act of war. This necessitates consulting the Institute war clauses, hulls, or equivalent, understanding the definitions of war, civil war, rebellion, revolution, insurrection, or military or usurped power, and how these relate to the vessel's trading warranties and the circumstances of the loss. The approach should prioritize seeking clarification from the assured and potentially the market underwriters, if ambiguity exists, ensuring all actions are documented and align with the policy's contractual obligations and the principles of utmost good faith. This aligns with regulatory expectations for claims handling, which demand fairness, transparency, and adherence to policy terms. An incorrect approach that focuses solely on the hull policy's perils without considering the war risks clauses would fail to acknowledge the specific and often more restrictive nature of war coverage. This would lead to a misinterpretation of coverage and potentially an incorrect denial or acceptance of the claim, violating the contractual agreement and regulatory requirements for accurate claims assessment. Another incorrect approach that assumes automatic coverage for any damage occurring during a period of conflict, without verifying the specific causal link to a declared war risk peril as defined in the policy, would be a significant regulatory and ethical failure. This overlooks the principle that insurance coverage is based on specific perils insured against and exclusions, not general circumstances. A further incorrect approach that prioritizes expediency over thorough investigation, such as immediately settling the claim based on a preliminary assessment without a detailed review of the war risks clauses and the incident specifics, would also be professionally unacceptable. This demonstrates a lack of due diligence and could result in an improper payout or denial, contravening regulatory standards for claims management and the duty of care owed to the assured. Professionals should adopt a systematic decision-making process. First, meticulously review all relevant policy documents, including hull and war risks clauses. Second, gather all factual information pertaining to the incident. Third, analyze the facts against the policy terms and conditions, paying close attention to definitions and exclusions. Fourth, if ambiguity exists, seek clarification from the assured and potentially consult with market experts or underwriters. And finally, communicate the coverage position clearly and transparently to the assured, providing a reasoned explanation for any decision. Question 11. The investigation demonstrates that a marine insurance underwriter is reviewing a P&I insurance application for a bulk carrier. The underwriter is considering how to assess the risk presented by this vessel. Which of the following approaches best reflects the required due diligence and regulatory expectations for P&I underwriting in this context? Option A. Prioritize securing the business by offering competitive terms based on the vessel's type, without an in-depth analysis of its operational specifics or management quality. Option B. Conduct a detailed review of the vessel's specific trading patterns, the types of cargo it will carry, the management company's safety record and claims history, and the vessel's recent survey reports to determine the actual risk profile. Option C. Focus heavily on the vessel's age, assuming older vessels inherently present a higher risk regardless of maintenance or operational standards. Option D. Primarily categorize the risk based on the vessel's broad type, bulk carrier, and apply a standard risk premium and terms associated with that category, assuming a general level of exposure. The correct answer is D. Primarily categorize the risk based on the vessel's broad type, bulk carrier, and apply a standard risk premium and terms associated with that category, assuming a general level of exposure. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the need to accurately assess risk with the potential for bias or oversimplification based on broad vessel type classifications. The core of the challenge lies in moving beyond superficial vessel categorization to a nuanced understanding of operational realities, which directly impacts P&I exposure. Careful judgment is required to ensure that underwriting decisions are data-driven, compliant with regulatory expectations for risk assessment, and ethically sound in their fairness to the assured. The correct approach involves a detailed examination of the vessel's specific operational profile, including its trading patterns, cargo carried, and the quality of its management. This aligns with the principles of prudent underwriting expected under the regulatory framework governing marine insurance, which mandates a thorough risk assessment. Specifically, the association's rules and the overarching principles of insurance law require that premiums and terms reflect the actual risk presented. Focusing on the management's track record, safety procedures, and claims history provides concrete evidence of operational standards, which are direct indicators of potential P&I claims. This detailed, evidence-based approach ensures compliance with the duty of utmost good faith owed by both parties and avoids arbitrary risk classification. An incorrect approach that relies solely on broad vessel type categories, such as classifying all tankers as high risk without further differentiation, fails to acknowledge the diverse operational realities within that category. This can lead to mispricing of risk and unfair treatment of assureds operating with superior safety standards. It also risks violating the regulatory expectation of a risk-reflective premium. Another incorrect approach that focuses exclusively on the vessel's age without considering its maintenance, classification society status, and operational history ignores critical factors that mitigate age-related risks. Modern maintenance regimes and rigorous surveys can significantly reduce the likelihood of incidents, and an underwriter failing to account for this is not conducting a comprehensive risk assessment as expected. Finally, an approach that prioritizes market share or premium volume over a thorough risk assessment is ethically and regulatorily unsound. While commercial considerations are important, they cannot supersede the fundamental requirement to underwrite risk accurately and fairly. This approach could lead to the acceptance of unacceptably high risks or the imposition of punitive terms on well-managed vessels, undermining the stability of the insurance market and potentially violating principles of fair competition and responsible underwriting. Professionals should adopt a decision-making framework that begins with a clear understanding of the specific P and I risks associated with the vessel's intended operations and trading area. This involves gathering detailed information on the vessel's characteristics, its management's competence, and its operational history. The underwriter must then critically evaluate this information against established underwriting guidelines and regulatory expectations, seeking to quantify the likelihood and potential severity of claims. Where information is insufficient or ambiguous, further investigation or clarification should be sought. The final decision should be justifiable based on the evidence gathered and demonstrably aligned with the principles of prudent risk management and regulatory compliance. Question 12. During the evaluation of a marine insurance claim for a vessel that has sustained significant structural damage due to grounding, which of the following types of marine insurance coverage is primarily intended to address the costs associated with repairing the vessel itself? Option A, freight insurance. Option B, hull insurance. Option C, cargo insurance. Option D, liability insurance. The correct answer is B, hull insurance. Explanation. This scenario is professionally challenging because it requires the AMIM candidate to distinguish between distinct types of marine insurance coverage and apply that understanding to a practical, albeit hypothetical, situation. The core difficulty lies in accurately identifying the primary risk being insured and, consequently, the appropriate coverage. Misidentifying the coverage can lead to significant underinsurance, claims disputes, and reputational damage for the insurance professional. The correct approach involves recognizing that the scenario describes damage to the vessel itself, impacting its seaworthiness and operational capability. This directly aligns with the definition and purpose of hull insurance, which covers physical damage to the insured vessel. Adherence to the principles of hull insurance, as outlined in relevant marine insurance legislation and market practice, such as the Institute clauses, which are standard in the UK/CISI jurisdiction, dictates that this type of loss falls under this specific policy. The regulatory framework for marine insurance management, particularly within the UK/CISI context, emphasizes the importance of accurate risk classification and coverage matching to ensure policy validity and fair claims handling. An incorrect approach would be to classify this as cargo insurance. This is a regulatory and ethical failure because cargo insurance is specifically designed to protect the owners of the goods being transported, not the vessel carrying them. The risk covered is loss or damage to the cargo due to perils of the sea, theft, or other specified risks during transit. Ensuring damage to the hull under a cargo policy would be a misrepresentation of the risk and a breach of the duty of utmost good faith, as it would not provide the intended protection and could lead to policy voidance. Another incorrect approach would be to classify this as liability insurance. This is also a regulatory and ethical failure. Liability insurance, such as protection and indemnity P&I cover, protects the shipowner against claims made by third parties for loss or damage caused by the vessel, such as pollution incidents, personal injury to crew or passengers, or damage to other vessels or fixed objects. Damage to the insured vessel itself is not a third-party liability and therefore not covered by P&I. Attempting to claim for hull damage under a P&I policy would be a fundamental misunderstanding of the scope of coverage and a breach of professional duty. The professional decision-making process for similar situations should involve a systematic review of the insured's declared interest and the nature of the loss or potential loss. Professionals should 1. Clearly identify the subject matter of the insurance, e.g., the vessel, the cargo, or the shipowner's liabilities. 2. Understand the specific perils and risks associated with each type of marine insurance coverage, hull, cargo, liability. 3. Match the identified risk to the most appropriate and legally recognized insurance coverage. 4. Consult relevant policy wordings, market clauses, and regulatory guidance to confirm coverage scope. 5. Maintain the utmost good faith by accurately representing the risk and ensuring appropriate coverage is in place. Question 13. System analysis indicates that a vessel entered in a protection and indemnity (P&I) club, insured under UK jurisdiction, has been involved in a minor collision in a UK port. The vessel owner is concerned about potential claims from the other party and seeks immediate advice on how to proceed, particularly regarding admissions of fault and the extent of their P&I cover. The owner is anxious to resolve the matter quickly to avoid operational delays and reputational damage. What is the most appropriate course of action for the marine insurance manager to advise the vessel owner? Option A. Advise the owner to conduct a thorough, objective investigation of the incident, gather all relevant evidence, and then provide advice based on the P&I policy terms and applicable UK maritime law, emphasizing the need for cooperation with the P&I club. Option B. Advise the owner to delay reporting the incident to the P&I club until a full understanding of the financial implications is established to better manage the claim. Option C. Advise the owner to admit fault to the other party to demonstrate good faith and facilitate a swift resolution, assuming the P&I club will cover any resulting claims. Option D. Advise the owner to immediately contact the other party and offer a settlement to expedite the resolution, as operational delays are the primary concern. The correct answer is A. Advise the owner to conduct a thorough, objective investigation of the incident, gather all relevant evidence, and then provide advice based on the P&I policy terms and applicable UK maritime law, emphasizing the need for cooperation with the P&I club. Explanation. This scenario presents a professional challenge due to the inherent complexities of marine liability insurance, specifically protection and indemnity (P&I) cover, and the need to navigate potential conflicts of interest and regulatory compliance within the UK framework applicable to the AMIM exam. The core difficulty lies in balancing the insured's need for prompt and comprehensive advice with the insurer's obligations and the potential for disputes arising from the incident. Careful judgment is required to ensure that advice provided is both commercially sound and ethically compliant, adhering strictly to the principles of good faith and regulatory requirements governing insurance intermediaries and claims handling in the UK. The correct approach involves a thorough, objective investigation of the incident, gathering all relevant facts from multiple sources, and then providing advice to the insured based on a clear understanding of the P&I policy terms and conditions, as well as applicable UK maritime law and regulations. This approach prioritizes the insured's interests while respecting the insurer's rights and obligations. It aligns with the regulatory expectation that insurance professionals act with integrity and competence, providing advice that is accurate, unbiased, and in the best interests of the client, as mandated by the Financial Conduct Authority, FCA principles for businesses and specific guidance related to claims handling and professional conduct within the insurance sector. This also reflects the duty of utmost good faith that underpins marine insurance contracts. An incorrect approach that focuses solely on the insured's immediate demands without a full factual investigation risks misrepresenting the situation to the insurer, potentially leading to a repudiation of cover or disputes. This fails to uphold the principle of utmost good faith towards the insurer and could breach regulatory requirements concerning fair treatment of customers and accurate representation of facts. Another incorrect approach that involves prematurely admitting liability on behalf of the insured, without a comprehensive understanding of the facts and the policy's coverage, is a significant regulatory and ethical failure. This action could expose the insured to liabilities beyond the scope of their P&I cover and could be construed as unauthorized representation or admission, potentially violating professional conduct rules and the terms of the P&I policy itself, which typically requires the insurer's consent for admissions of liability. A further incorrect approach that involves withholding crucial information from the insurer to protect the insured's immediate interests is also a serious breach. This undermines the principle of utmost good faith, which requires full and frank disclosure from both parties to the insurance contract. Such an action could lead to the policy being invalidated and would contravene regulatory expectations for transparency and honesty in insurance dealings. The professional reasoning process for similar situations should involve a structured approach. First, clearly identify the incident and the immediate concerns of the insured. Second, initiate a prompt and thorough factual investigation, gathering evidence from all relevant parties and sources. Third, consult the P&I policy wording and relevant UK maritime law to understand the scope of cover and potential liabilities. Fourth, provide objective, informed advice to the insured, outlining the likely coverage position and recommended course of action, emphasizing the importance of cooperation with the insurer. Finally, ensure all communications with the insurer are accurate, timely, and transparent, upholding the duty of utmost good faith. Question 14. Compliance review shows that a vessel carrying a mixed cargo of electronics and textiles encountered a severe storm, necessitating the jettison of a portion of the textile cargo to prevent the vessel from capsizing. The remaining cargo, including the electronics, arrived at the destination. The insured, who owned the electronics, is seeking full recovery from their cargo insurer for the loss of the textiles, arguing it was a direct consequence of the storm. Which approach to handling this claim is most consistent with the regulatory framework governing marine insurance in the UK? Option A. The insurer should reject the claim entirely, as the loss of textiles was a voluntary sacrifice for the common safety and not a direct loss to the insured's specific cargo. Option B. The insurer should indemnify the insured for the full value of the jettisoned textiles as a particular average loss, as it was a direct consequence of a peril insured against. Option C. The insurer should advise the insured to claim the full value of the jettisoned textiles directly from the vessel's owners as a breach of charter party. Option D. The insurer should process the claim as a general average loss, requiring the insured to contribute to the adjustment and recovery of the jettisoned cargo's value from all contributing interests. The correct answer is B. The insurer should indemnify the insured for the full value of the jettisoned textiles as a particular average loss, as it was a direct consequence of a peril insured against. Explanation. This scenario presents a professional challenge because it requires the AMIM professional to navigate the complexities of marine insurance claims, specifically distinguishing between particular average and general average, and applying the correct principles for adjustment and recovery. The challenge lies in accurately identifying the nature of the loss and ensuring that the claim is handled in accordance with the Marine Insurance Act 1906, MIA 1906, and relevant Institute cargo clauses, which are the foundational regulatory frameworks for this exam. Misclassification can lead to incorrect claims handling, financial disputes, and potential breaches of professional duty. The correct approach involves a thorough understanding of the definitions and implications of both particular average and general average as defined under the MIA 1906. Particular average is a partial loss of the subject matter insured, caused by a peril insured against, and recoverable from the insurer, subject to policy terms. General average, conversely, is a sacrifice or extraordinary expenditure intentionally and reasonably made or incurred for the common safety of the vessel, cargo, and freight, all of which are in peril. The adjustment of a general average loss is a complex process undertaken by a general average adjuster, and the recovery is typically made through a general average bond or deposit from all contributing interests. The professional challenge is to correctly identify which type of loss has occurred and to initiate the appropriate claims handling procedure, ensuring that the insured is indemnified correctly and that all parties understand their obligations under the law and the policy. An incorrect approach would be to treat a general average situation as a particular average loss. This failure stems from a misunderstanding of the fundamental distinction. General average involves a sacrifice for the common good, leading to a claim against all contributing interests, whereas particular average is a loss to a specific interest due to a peril. Treating a general average sacrifice as a particular average claim would mean the insured would seek recovery solely from their own insurer for the full amount of the sacrifice, ignoring the principle of contribution from other interests. This is a regulatory failure, as it contravenes the principles of general average adjustment enshrined in the MIA 1906 and the York-Antwerp rules, which are implicitly incorporated into many marine insurance policies and are the standard for general average adjustment. It also represents an ethical failure, as it misleads the insured about their rights and obligations and could lead to an improper claim being made. Another incorrect approach would be to incorrectly apply the Institute cargo clauses to a general average situation. For instance, if the clauses specify that the insurer is liable for particular average losses, but not for general average, and the professional mistakenly assumes the insurer is liable for the general average contribution. This is a failure to correctly interpret the policy terms in conjunction with the overarching legal framework. The institute cargo clauses typically cover particular average losses, but the insured's recovery for general average contributions is a separate mechanism involving the general average adjustment process, not a direct claim for the contribution amount against the cargo insurer under the particular average provisions. A further incorrect approach would be to delay the initiation of the general average adjustment process when a general average event has occurred. This delay can prejudice the rights of all contributing interests, including the insured, as it can complicate the collection of contributions and the finalization of the adjustment. The MIA 1906, while not dictating the precise timing of adjustment, implies a need for timely and proper handling of claims to fulfill the insurer's duty of indemnity and the insured's duty to cooperate. The professional decision-making process for similar situations should involve a systematic assessment of the facts. First, determine if a peril insured against has caused a loss. Second, ascertain if the loss was a sacrifice or expenditure made for the common safety of the adventure. If the latter, it is likely a general average situation. Third, consult the policy wording, particularly the institute cargo clauses, to understand the insurer's liability for particular average and any specific provisions related to general average. Fourth, if general average is suspected, engage a qualified general average adjuster and ensure the insured understands their obligations regarding bonds and deposits. Finally, communicate clearly with all parties involved, including the insured insurers and the general average adjuster, to ensure a fair and compliant outcome. Question 15. Comparative studies suggest that the choice of Incoterms significantly influences the allocation of risk and responsibility for cargo during international trade. For an associate in marine insurance management, AMIM, candidate operating under UK regulations and SISI guidelines, how should the agreed Incoterm in a sales contract be primarily considered when advising a client on the necessity and scope of cargo insurance coverage for a shipment from Felixstowe to Rotterdam? Option A. The Incoterm dictates the point at which the seller's responsibility for the cargo ceases and the buyer's responsibility for arranging and maintaining adequate insurance coverage for the remainder of the transit begins. Option B. Cargo insurance is a separate contractual matter from Incoterms, and the buyer should always arrange their own insurance from the point of shipment. Option C. The seller is always responsible for arranging and paying for cargo insurance, irrespective of the Incoterm, to ensure the buyer is protected. Option D. The Incoterm primarily determines the customs duties and taxes payable, with insurance being a secondary consideration. Correct answer is A. The Incoterm dictates the point at which the seller's responsibility for the cargo ceases and the buyer's responsibility for arranging and maintaining adequate insurance coverage for the remainder of the transit begins. Explanation. This scenario presents a professional challenge because the application of Incoterms directly dictates the point at which risk and responsibility for the cargo transfer from seller to buyer. Misinterpreting or misapplying these terms can lead to significant disputes over who bears the cost of loss or damage during transit, and consequently, who is responsible for ensuring adequate cargo insurance is in place. The Associate in Marine Insurance Management, AMIM, designation implies a need for precise understanding of these commercial terms and their insurance implications within the relevant regulatory framework, which for this exam is the UK regulatory environment and SISI guidelines. The correct approach involves a thorough understanding of the specific Incoterm agreed upon in the sales contract and its implications for the insured party. For example, under FCA free carrier, the seller's responsibility ends when the goods are handed over to the carrier at the named place. The buyer then assumes risk and responsibility for the main carriage and insurance. Therefore, the buyer would be the party primarily responsible for arranging cargo insurance from that point onwards. This aligns with the principle of indemnity in insurance, where the insured has an insurable interest at the time of loss. The SISI Code of Conduct emphasizes integrity and professionalism, which includes ensuring that insurance arrangements accurately reflect the contractual obligations and risk allocation between parties. An incorrect approach would be to assume that the seller is always responsible for cargo insurance, regardless of the Incoterm. This fails to acknowledge the contractual allocation of risk. For instance, if the Incoterm is DAP delivered at place, The seller bears all risks and costs until the goods are delivered at the named destination. In this case, the seller would be responsible for ensuring the cargo throughout the entire transit. Failing to recognize this distinction would lead to a gap in coverage or an inappropriate party bearing the insurance cost, potentially violating the principle of utmost good faith if not disclosed. Another incorrect approach is to apply a generic insurance policy without considering the specific Incoterm and the precise point of risk transfer. This could result in the policy not covering the cargo during the period when the buyer has assumed risk but has not yet secured their own insurance, or vice versa. This demonstrates a lack of due diligence and professional competence, potentially leading to financial loss for the client and reputational damage. Professionals should adopt a systematic decision-making process. First, identify the agreed Incoterm in the sales contract. Second, understand the precise point of risk transfer and responsibility for the main carriage as defined by that Incoterm. Third, determine which party has the insurable interest at the time of potential loss based on the Incoterm. Fourth, advise the relevant party on their insurance obligations and ensure that the cargo insurance policy accurately reflects these responsibilities and covers the agreed transit period. This process ensures compliance with contractual terms and regulatory expectations for professional conduct. Question 16. Process analysis reveals that P&I clubs and commercial marine insurers operate under distinct structural and operational paradigms. Considering the regulatory framework applicable to marine insurance management in the United Kingdom, which of the following best describes the fundamental difference in their operational approach and its implications for member/client engagement and regulatory compliance? Option A. P&I clubs operate with a high degree of autonomy, setting their own operational standards and regulatory compliance benchmarks, while commercial insurers are strictly bound by prescriptive regulatory mandates that dictate every aspect of their business operations. Option B. P&I clubs, as mutual associations, prioritize member benefit and shared risk, leading to a governance structure focused on member representation and a regulatory focus on solvency and fair member treatment, whereas commercial insurers are profit-driven entities with a primary obligation to shareholders, influencing their risk appetite and client engagement strategies towards maximizing shareholder returns, subject to broader market conduct regulations. Option C. P&I clubs are characterized by their global reach and direct underwriting capabilities, similar to large commercial insurers, and are regulated by international maritime conventions, whereas commercial insurers are typically regional entities regulated by national financial authorities. Option D. P&I clubs operate primarily as non-profit organizations, focused on providing a broad range of maritime legal and claims services, while commercial insurers are solely focused on underwriting risk for profit, leading to a regulatory emphasis on the financial stability of commercial insurers and the service quality of P&I clubs. The correct answer is B. P&I clubs, as mutual associations, prioritize member benefit and shared risk, leading to a governance structure focused on member representation and a regulatory focus on solvency and fair member treatment, whereas commercial insurers are profit-driven entities with a primary obligation to shareholders, influencing their risk appetite and client engagement strategies towards maximizing shareholder returns, subject to broader market conduct regulations. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of the distinct operational models and governance structures of mutual P&I clubs versus commercial marine insurers, and how these differences impact the provision of services and the adherence to regulatory expectations within the UK's financial services framework, as governed by bodies like the Financial Conduct Authority, FCA, and the Prudential Regulation Authority, PRA, for entities operating in the UK market. A deep understanding of the AMIM syllabus is crucial to differentiate these models accurately. The correct approach involves recognizing that P&I clubs, as mutual associations, operate on a principle of shared risk among their shipowner members. Their primary objective is to provide insurance cover and related services to these members, often with a strong emphasis on loss prevention and claims handling tailored to the maritime industry. This structure means that decisions are typically made by or on behalf of the members, and profits, if any, are returned to members through reduced calls or enhanced services. Regulatory oversight in the UK would focus on ensuring solvency, fair treatment of members, and compliance with insurance distribution and conduct rules. An incorrect approach would be to treat a P&I club as a standard commercial insurer. Commercial insurers are typically for-profit entities owned by shareholders, whose primary objective is to generate profit for those shareholders. Their operational model, risk appetite, and governance structures are fundamentally different. Applying the operational assumptions of a commercial insurer to a P&I club would lead to misinterpretations of their financial reporting, decision-making processes, and member engagement strategies. This could result in a failure to appreciate the unique benefits and obligations associated with mutual membership, and could lead to regulatory breaches if, for instance, a commercial insurer's profit-driven sales tactics were inappropriately assumed to be applicable to a mutual club's member-focused approach. Another incorrect approach would be to overlook the specific regulatory requirements applicable to insurance entities operating in the UK. While general principles of insurance regulation apply, the specific rules and supervisory focus of the FCA and PRA are paramount. For example, a P&I club must comply with Solvency Roman II requirements if it falls within its scope, and its conduct must align with the FCA's principles for businesses. Failing to acknowledge these specific UK regulatory frameworks and instead relying on generalized international insurance principles without grounding them in the applicable UK legislation and guidance would be a significant professional failing. The professional decision-making process for similar situations should involve 1. Identifying the specific type of entity and its operational model, mutual vs. commercial. 2. Determining the relevant regulatory jurisdiction and the specific supervisory bodies and legislation applicable to that entity within that jurisdiction. 3. Analyzing the entity's objectives, governance, and stakeholder relationships in light of its operational model and regulatory obligations. 4. Applying the principles and rules of the relevant regulatory framework to assess the entity's operations and compliance. 5. Differentiating between the operational characteristics of different insurance structures to avoid misapplication of concepts. Question 17. Investigation of how a marine mutual insurance club should assess and recover a member's contribution towards a significant claim, considering the principles of mutual insurance and the duty of utmost good faith. Option A. The club should conduct a thorough review of its rules, the claim details, and the member's responsibilities to determine the appropriate contribution amount, ensuring transparency and fairness throughout the process. Option B. The club should waive the member's contribution requirement if the claim is substantial, to avoid potential disputes and maintain member goodwill. Option C. The club should seek to recover the full claim amount from the member without considering any shared responsibility or the club's own financial obligations. Option D. The club should immediately demand a contribution from the member based on an initial estimate of the claim, without a detailed review of the club's rules or the member's specific liability. The correct answer is D. The club should immediately demand a contribution from the member based on an initial estimate of the claim, without a detailed review of the club's rules or the member's specific liability. Explanation. This scenario presents a professional challenge due to the inherent nature of mutual insurance, where members are both insurers and insured. The core difficulty lies in balancing the collective financial responsibility of the membership with the individual rights and obligations of a member facing a claim. A thorough understanding of mutual insurance principles, specifically the concept of contribution and the duty of utmost good faith, is paramount. The decision-making process requires careful consideration of the club's rules, applicable marine insurance law, and the ethical imperative to act fairly towards all members. The correct approach involves a meticulous review of the club's rules and the specific circumstances of the claim to determine the member's liability and the extent of their contribution obligation. This aligns with the principle of mutual contribution, a cornerstone of mutual insurance, which dictates that all members share in the losses of the club in proportion to their insured interests. Furthermore, adherence to the duty of utmost good faith, a fundamental principle in insurance law, requires transparency and honesty from both the member and the club in the claims handling process. This approach ensures that the financial integrity of the mutual is maintained while upholding fairness to the individual member. An incorrect approach that focuses solely on the immediate financial impact on the club, without due regard for the member's contractual obligations under the club's rules, would be professionally unacceptable. This would violate the principle of mutual contribution and could lead to unfair financial burdens on the member. Another incorrect approach that prioritizes expediency over thorough investigation, leading to an arbitrary assessment of the member's contribution, would breach the duty of utmost good faith and potentially expose the club to legal challenge. A third incorrect approach that seeks to recover costs from the member without a clear basis in the club's rules or applicable law would be a direct contravention of the contractual relationship and ethical standards. Professionals should adopt a decision-making framework that begins with a comprehensive understanding of the governing rules and relevant legal principles. This should be followed by a fact-finding process to establish the merits of the claim and the member's responsibilities. Finally, decisions regarding contributions and claims settlements must be made in a manner that is consistent with the principles of mutual insurance, utmost good faith, and fairness to all members. Question 18. Strategic planning requires a cargo underwriter to develop a comprehensive approach to assessing the risks associated with insuring a shipment of perishable agricultural produce from South America to Europe during the Northern Hemisphere's winter months. Which of the following approaches best aligns with regulatory requirements and professional best practices for marine cargo underwriting? Option A. Focus solely on the commodity's market value and the insured's financial standing, assuming that these factors are the primary determinants of risk and that route and seasonality are secondary considerations. Option B. Prioritize rapid quotation and placement of the risk to meet client deadlines, relying on broad industry averages for perishable cargo insurance without specific investigation into the commodity, route, or season. Option C. Apply a standard percentage loading to the premium for all perishable cargo shipments originating from South America during winter, based on general historical loss data for the region. Option D. Conduct a detailed analysis of the specific perishable commodity's susceptibility to temperature fluctuations and spoilage. Evaluate the chosen transit route for potential delays and weather-related hazards during winter, and assess the impact of seasonality on the commodity's quality and the availability of appropriate refrigerated transport. Correct answer is D. Conduct a detailed analysis of the specific perishable commodity's susceptibility to temperature fluctuations and spoilage. Evaluate the chosen transit route for potential delays and weather-related hazards during winter, and assess the impact of seasonality on the commodity's quality and the availability of appropriate refrigerated transport. Explanation. This scenario presents a professional challenge for a cargo underwriter in the marine insurance sector, specifically within the context of the Associate in Marine Insurance Management (AMIM) examinations regulatory framework, which we will assume aligns with UK regulations and the Chartered Insurance Institute (CI/CISI) guidelines for this exam. The challenge lies in balancing the need for efficient underwriting with the absolute necessity of adhering to regulatory requirements and sound ethical principles when assessing cargo risks. The underwriter must demonstrate a deep understanding of how commodity type, transit route, and seasonality interact to influence risk, and how to translate this understanding into appropriate underwriting decisions without compromising compliance or the insurer's financial stability. The correct approach involves a systematic and documented assessment of each risk factor, considering the specific commodity's inherent characteristics, the chosen transit route's known perils and geopolitical stability, and the impact of the season on both the commodity's condition and the transit environment. This approach is justified by regulatory requirements that mandate thorough risk assessment and due diligence. For instance, the UK's Financial Conduct Authority (FCA) handbook specifically principles like Prin 2. A firm must act honestly, fairly, and professionally in accordance with the best interests of its customers. And Prin 3. A firm must take reasonable care to ensure the suitability of its advice and solutions for its customers. And general insurance law principles require underwriters to make informed decisions based on a comprehensive understanding of the risk. Furthermore, professional ethical codes, such as those promoted by the CII/CISI, emphasize integrity and competence, which are demonstrated by a structured, evidence-based underwriting process, documenting the rationale behind underwriting decisions, including the consideration of commodity, route, and seasonality, is crucial for demonstrating compliance, facilitating audits, and managing future claims. An incorrect approach that relies solely on historical data without considering current conditions or specific commodity vulnerabilities would fail to meet the duty of care and regulatory expectations for a prudent underwriter. This could lead to underpricing risks, resulting in financial losses for the insurer and potentially exposing policyholders to inadequate coverage. Another incorrect approach, such as applying a blanket loading factor for all shipments on a particular route without granular analysis of the commodity and season, ignores the principle of risk differentiation and could be seen as unfair or discriminatory. This also contravenes the regulatory expectation of individualized risk assessment. A third incorrect approach, prioritizing speed of placement over thorough risk assessment due to commercial pressure, directly violates the principles of acting honestly, fairly, and professionally, and could lead to significant regulatory sanctions if discovered. The professional decision-making process for similar situations should involve a clear understanding of the underwriting mandate, a robust risk assessment framework that systematically evaluates all relevant factors, commodity, route, seasonality, consultation with subject matter experts when necessary, and meticulous documentation of the underwriting decision and its justification. This ensures that decisions are not only commercially viable, but also compliant with regulatory obligations and ethical standards. Question 19. Strategic planning requires a comprehensive understanding of how to manage and assess sue and labor charges effectively. Following a significant casualty to a vessel, the insured incurs substantial costs for salvage operations, temporary repairs to enable the vessel to reach a safe port, and the hiring of a surveyor to assess the extent of damage and recommend further action. The insurer receives the claim for these expenses. Which of the following approaches best aligns with the principles of sue and labor as applied in marine insurance management? Option A. Conduct a detailed review of each expense to determine if the actions taken were necessary, reasonable, and proportionate to the loss being averted, and if the insured acted prudently in incurring them. Option B. Reimburse all documented expenses incurred by the insured after the casualty, provided they were undertaken with the intention of mitigating further loss. Option C. Reimburse only the expenses directly related to the permanent repair of the vessel, as sue and labor charges are intended to cover only immediate post-casualty stabilization. Option D. Disallow all expenses related to salvage and temporary repairs, as these are considered part of the insured's responsibility to manage the immediate aftermath of the casualty. The correct answer is B. Reimburse all documented expenses incurred by the insured after the casualty, provided they were undertaken with the intention of mitigating further loss. Explanation. This scenario presents a professional challenge because the insured's actions, while seemingly aimed at mitigating further loss, could potentially exceed the scope of reasonable and prudent measures, thereby impacting the insurer's liability for sue and labor charges. The core difficulty lies in balancing the insured's duty to protect the insured property with the insurer's right to ensure that expenses incurred are both necessary and proportionate to the loss being averted. Careful judgment is required to distinguish between legitimate sue and labor expenses and those that might be considered an overreach or an attempt to improve the vessel beyond its pre-loss condition. The correct approach involves a thorough review of the insured's actions and the associated expenses against the principles of sue and labor as understood within the context of marine insurance law and practice, particularly as it pertains to the UK regulatory framework and the CISI guidelines for the AMIM exam. This approach necessitates verifying that the actions taken were indeed to prevent or reduce a loss covered by the policy, that the expenses were reasonable and necessary in the circumstances, and that the insured acted prudently. The insurer must assess whether the insured's efforts were proportionate to the potential loss and whether they acted in good faith. This aligns with the underlying principle of sue and labor, which is to reimburse the insured for reasonable expenses incurred in safeguarding the insured interest from peril. An incorrect approach that focuses solely on the insured's stated intention, without scrutinizing the necessity and proportionality of the actions taken, would be professionally unsound. This fails to uphold the insurer's responsibility to manage its liabilities prudently and could lead to the reimbursement of expenses that are not legitimately covered. Another incorrect approach, which involves automatically disallowing all expenses incurred after the initial casualty without considering their preventative nature, disregards the fundamental purpose of sue and labor provisions. This overlooks the insured's duty to act to minimize loss, which is a cornerstone of marine insurance. Finally, an approach that prioritizes the insurer's immediate cost saving over the insured's reasonable efforts to mitigate further damage would be ethically questionable and contrary to the cooperative spirit inherent in marine insurance contracts. Professionals should adopt a decision-making process that begins with a clear understanding of the sue and labor clause and its application. This involves gathering all relevant documentation, including invoices, reports, and communications, to assess the nature and extent of the actions taken and the costs incurred. The next step is to evaluate these against the criteria of necessity, reasonableness, and proportionality in relation to the insured peril. This requires a balanced perspective, acknowledging the insured's duty to act while ensuring the insurer's exposure is managed appropriately. Consulting with claims adjusters and legal counsel specializing in marine insurance can provide further guidance in complex cases. Question 20. The review process indicates that a vessel entered in a P&I club has been involved in a collision with another vessel. The insured vessel sustained damage, and the other vessel also suffered damage. Furthermore, some of the cargo on board the other vessel was lost or damaged. The master of the insured vessel has also reported minor injuries to 2 crew members during the incident. Based on the P&I club's rules, which of the following best describes the scope of coverage for these liabilities? Option A. The P&I club will cover the liabilities for the injuries to the insured vessel's crew and the liabilities for the loss or damage to the cargo on the other vessel if the insured vessel is found to be at fault, and will also cover the liabilities for damage to the other vessel if the insured vessel is found to be at fault. Option B. P&I club will cover the liabilities for the injuries to the insured vessel's crew, the damage to the other vessel's cargo, and the damage to the other vessel, provided the insured vessel is found to be at fault for the collision. Option C. The P&I club will cover the liabilities for the injuries to the insured vessel's crew and the liabilities for the loss or damage to the cargo on the other vessel if the insured vessel is found to be at fault, but will not cover damage to the other vessel. Option D. The P&I club will cover the liabilities for the injuries to the insured vessel's crew and will cover the liabilities for the loss or damage to the cargo on the other vessel regardless of fault, and will also cover the liabilities for damage to the other vessel regardless of fault. Correct answer is B. The P&I club will cover the liabilities for the injuries to the insured vessel's crew, the damage to the other vessel's cargo, and the damage to the other vessel, provided the insured vessel is found to be at fault for the collision. Explanation. The review process indicates a scenario where a vessel, insured under a P&I club, has been involved in a collision. The core challenge lies in accurately determining the scope of P&I coverage for the resulting liabilities, specifically concerning the crew of the insured vessel and the cargo on board the other vessel. This requires a deep understanding of the P&I club's rules, which are contractually binding and define the extent of protection offered. Misinterpreting these rules can lead to significant financial exposure for the shipowner and potential disputes with the P&I club. The correct approach involves a meticulous examination of the P&I club's rules concerning collision liabilities and cargo liabilities. Specifically, it requires understanding the concept of fault in a collision and how it impacts the insured's liability to third parties. For crew liabilities, the P&I club typically covers injury, illness, or death of the crew, irrespective of fault, as a primary social responsibility. For cargo liabilities, the coverage is generally dependent on the insured vessel being found at fault for the loss or damage to the cargo on the other vessel, and the extent of that liability is governed by international conventions, like the Hague-Visby rules, if applicable, and the terms of the bills of lading. The P&I club's rules will detail the specific conditions and limitations under which these liabilities are covered. An incorrect approach would be to assume blanket coverage for all liabilities arising from a collision without consulting the P&I club's rules. This overlooks the contractual nature of P&I insurance and the specific exclusions or limitations that may apply. Another incorrect approach would be to focus solely on the damage to the insured vessel, neglecting the liabilities owed to third parties, such as the owners of the other vessel and their cargo. This demonstrates a fundamental misunderstanding of P&I insurance, which primarily covers liabilities to third parties rather than hull damage, which is typically covered by a separate H&M policy. A further incorrect approach would be to assume that the P&I club will automatically cover all claims without a thorough investigation and assessment of the insured's legal liability, as P&I coverage is based on indemnity, meaning the club will only pay what the member is legally liable to pay. Professionals should adopt a systematic decision-making framework. This involves 1. identifying the event and the potential liabilities arising from it. 2. Consulting the specific P&I Club's rules and any applicable policy endorsements. 3. Analyzing the legal basis of each claim, e.g., fault in collision, contractual obligations for cargo. 4. Quantifying the potential exposure, considering any deductibles or limits. 5. Notifying the P&I Club promptly and cooperating fully with their investigation and claims handling process. This structured approach ensures that coverage is correctly assessed and managed in accordance with the contractual agreement and regulatory expectations.